Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden secrets within quarterly financial reports. Today we're diving deep into Fuse Group Holding Incorporated's latest filing, and let me tell you, this one has some interesting twists and turns, particularly when it comes to their finances. Stick around. Because we're about to separate the facts from the fluff before we jump too far in, if you are new here and love getting straight answers from these Wall Street documents without the jargon, hit that subscribe button. We also have a fantastic community over on our Discord server, a link to which you'll find in the description below. It is the perfect place to discuss these findings and connect with other curious minds. Alright, let's get straight into it. This is Fuse Group Holding Inc. and its subsidiaries, and they've just dropped their quarterly report for the period ending the 31st of December, 2025. Think of this as a financial checkup for the last 3 months of the year. First up, we always want to look at the balance sheet. This is like a snapshot of what the company owns and what it owes at a specific moment. For the 31st of December 2025, we see their total assets were about $29,985. That might sound small, but compared to its liabilities, it tells a story. Speaking of liabilities, their total liabilities are a whopping $512,978. That's a massive difference. You can see their current liabilities, which are debts due within a year, are around $350,000. This includes a significant loan payable of over $319,000. They also have a loan payable that's not due in the immediate future, and some convertible notes. And then we have the stockholders deficit. This is where things get a bit concerning. They have a deficit of about $482,993. What this means is that the company owes more than it is worth based on its assets and liabilities. It is a strong indicator of financial strain, suggesting that if the company were to liquidate its assets and pay off all its debts, there wouldn't be anything left for the shareholders. Now let's look at how they performed financially over the 3 months. This is the statement of operations, which shows their revenue and expenses. For the 3 months ended the 31st of December 2025, their revenue was $7,683. Now, that's a decrease from the same period in the previous year, 2024, when they brought in $19,942. So revenue is definitely trending downwards. And when you look at their operating expenses, which were $38,828 for the period, it's clear they spent much more than they earned. This resulted in a loss from operations of $31,145. This pattern of losing money from core business activities is a common theme for this company. And if we look at the bottom line, their net loss for the quarter was $32,492. For context, in the same quarter of 2024, the net loss was even larger at $50,203. So while they are still losing money, the loss has shrunk a bit. This could be seen as a positive, but it's important to remember it's still a loss. This statement details the changes in the company's equity. As we saw in the balance sheet, it is a deficit. They had a deficit of $450,501 at the start of the period, and due to the net loss of $32,492, that deficit grew to $482,993 by the end of the quarter. This ongoing increase in deficit is a crucial point to monitor. Let's dive into the cash flow statement. This tells us where the company's cash is coming from and where it is going. For the 3 months ended the 31st of December 2025, their cash used in operating activities was $23,502. This means their day-to-day business operations consumed cash. This is consistent with their reported net loss. In the prior year, they used even more cash, $48,187. For operations. So again, a decrease in cash outflow from operations is noted, but it is still a negative number. What is interesting here is their financing activities. In the latest quarter, they actually had cash provided by financing activities of $22,814. This came from proceeds from a loan payable of $22,000 and an advance from their CEO for $3,000. This influx of cash helped offset some of the cash outflow from operations. In the previous year, they used $59,800 in financing activities. Considering all these activities, their net change in cash and cash equivalents for the quarter was a decrease of $688. Their cash balance at the end of the period was $20,472. This low cash balance combined with their liabilities is a key concern for liquidity. Now, let's look at the notes to the financial statements. These provide important context. Note 1 tells us about the company's history and what they do. Fuse Group Holding Inc. was incorporated in Nevada and is involved in mining and biotech, but they've also been diversifying into consulting services, especially in catering and culinary. They have subsidiaries like Fuse Processing Inc. and Fuse Biotech Inc. It seems they've been exploring various business avenues, which can be both a strength and a weakness, as it can spread resources thin. Note 2 covers their accounting policies. They use us generally accepted accounting principles, or US GAAP. They also mention that they are an emerging growth company and have elected to use the extended transition period for new accounting standards. This gives them a bit more flexibility in adopting new rules. They also talk about the use of estimates in their financial statements, which is standard, but it does mean that actual results could differ from what is reported. This is a critical note. Note 3 addresses the going concern assumption. This is basically the auditor's way of saying whether the company is likely to stay in business for the next year. The report clearly states that their accumulated deficit, their recent net losses, and their negative cash flow from operations raise substantial doubt about the company's ability to continue as a going concern. This is a major red flag. They mention plans to raise money through offerings or loans, but there is no guarantee they'll succeed. Looking at note 6 about convertible notes, we see they have two series of notes, both with a 3% interest rate. One matures in 2026 and another in 2027. These notes can be converted into shares of common stock. The interest rates are relatively low, but the conversion feature means that if the company's stock price rises significantly, these notes could become shares, potentially diluting existing shareholders. The total outstanding balance for these convertible notes is $70,000. Note 7 details their loans payable. They have an IDL loan from the Small Business Administration, which is over $92,000. They also have loans totaling over $270,000 from Sansage Capital Company Limited and additional non-interest bearing loans from individuals. The sum of these loans, especially when combined with their other liabilities, adds significant financial pressure. This note tells us more about their revenue. They provide consulting services in the mining and hospitality industries. For the 3 months ending the 31st of December 2025, they had one customer who accounted for 100% of their revenue, while single customer reliance can be lucrative if the relationship is stable. It also represents a significant risk. If that one customer leaves, their revenue disappears. Now we move into the management's discussion and analysis, or MDA. This is where management talks about the company's performance, financial condition, and future outlook. They start with a cautionary statement, which is standard warning that forward-looking statements could be incorrect due to various risks and uncertainties. They urge us to read it alongside their annual reports. The overview section reiterates that Fuse Group is involved in mining, biotech, and consulting services. They mention past efforts to acquire companies and explore mining targets. It sounds like they are still trying to find their footing and have a diverse range of business interests. When they discuss the results of operations, they again highlight the decrease in revenue from $19,942 in 2024 to $7,680. $3 in 2025, they attribute this to lower demand from clients and fewer consulting services provided. The cost of revenue was nil for both periods, which generally means their services don't have direct production costs, leading to a gross profit equal to their revenue. Looking at costs and expenses, they show a decrease in general and administrative expenses from $66,798 in 2024 to $38,828 in 2025. This decrease is mainly due to lower personnel and rent costs, offset by an increase in professional fees. This reduction in operating expenses is positive, as it means they are spending less to run the business. Non-operating expenses increased slightly from $947 in 2024 to $1,347 in 2025. This is primarily due to interest expenses on their IDL loan and convertible notes. They present a table on working capital, which is current assets minus current liabilities. They have a working capital deficit of negative $320,238 at the end of 2025. This means their short-term liabilities far exceed their short-term assets, reinforcing the going concern dilemma. In the liquidity section, they explicitly state that if they are not successful in their mining and consulting businesses and don't achieve profitability and positive cash flow, additional capital will be required. They are exploring options for financing, including selling debt or equity, but there is no assurance of success. This echoes the concerns raised in the going concern note. They reiterate that cash used in operating activities decreased from $48,187 in 2024 to $23,502 in 2025. They attribute this reduction in cash outflow to a smaller net loss after accounting for non-cash items and also changes in accounts payable and other liabilities. The financing activities section again highlights the cash provided by financing activities in 2025. mainly from new loans and an advance from their CEO. This inflow helped buffer the cash used in operations. This section is crucial for understanding internal governance. They acknowledge that their disclosure controls and procedures were not effective due to material weaknesses. One of the most significant is that they lack sufficient accounting personnel with the right knowledge and experience in US GAAP and SEC reporting. They also don't have an audit committee, and their IT controls are lacking. They are trying to fix this by hiring outside help, but it's a clear sign of internal control issues. For legal proceedings, they state they are not currently a party to any. This is generally good news, but they do add that as they grow, they may face more lawsuits. The exhibit section lists supporting documents, often certifications from their principal officers. Finally, the signatures, it is signed by Umesh Patel, who is listed as the Chief Executive Officer and Chief Financial Officer, and also the Principal Financial Officer and Accounting Officer. This dual role is often seen in smaller companies, but it can also point to a lack of segregation of duties, which is a common internal control weakness. So, what is the story here? Fuse Group Holding Inc. is a company with ambitious plans across multiple sectors like mining, biotech, and consulting. However, the financial picture presented in this filing is quite concerning. They are operating at a loss, have a significant accumulated deficit, and a substantial working capital deficit. The going concern note is a serious warning sign that the company may struggle to survive without additional funding. The slight reduction in revenue loss and operating expenses is a positive step, but it doesn't offset the fundamental ongoing financial challenges. The reliance on external financing, including loans and potential equity sales, is critical for their survival. The lack of robust internal accounting controls and the concentrated revenue source from a single customer add to the risk profile. In essence, Fuse Group is in a high-risk, speculative phase. Their diversification strategy is broad, and it remains to be seen if they can successfully monetize any of these ventures to achieve profitability and operational stability. For investors, this report signals a need for extreme caution. The potential for a turnaround exists, but it is heavily dependent on their ability to secure significant funding and execute their business plans effectively. Alright, that is our breakdown of Fuse Group Holding Inc. Its latest financial report. What are your thoughts on these numbers and what they signal for the company's future? Drop your insights in the comments below if you found this analysis valuable. Hitting that like button really helps us out, and don't forget to subscribe for more deep dives into corporate finances. And remember to check out our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.